Hello, everyone, and thank you for taking time out of your busy day to join us for today's call. We promise not to waste it. Just a couple things before I hand the show over to today's guest. The lines are muted, so if you have any questions, feel free to use the chat feature in your control panel. I will be watching, so as we go, I can answer those questions, or if you prefer, you can write them down and give us a call. Your marketing team will be happy to help you. Now, the focus of today's call will be usable content and removing the lack of confidence in approaching the booming business owner market. Our presenter today, Ellen Lehmert, she is currently the Director of Advanced Planning with the National Life Group. Prior to her joining the National Life Group, Ellen was in private practice spanning two worlds, advanced planning consultant and attorney at law. She brings over 20 years of experience specializing in the design of business succession, business benefit plans, as well as estate planning for business owners and other high net worth clients. Ellen has authored numerous articles and presented at many industry meetings, including $1 Million Roundtable and much, much more. With that, I'm going to give the show over to you, Ellen.
Hey, thank you, and good afternoon, good morning, wherever you happen to be. I guess it's good morning practically everywhere. I always love to talk about how to work with or opportunities for working with business owners. It is a great marketplace to be in. And for some folks, I will admit, some folks find it a little scary, a little intimidating. Business owners have a world of other needs than regular folks, regular employees of other businesses. The first thing I like to remind everybody is that no matter what you are or where you're talking with a business owner or what presentations you're making in perhaps in some of the advanced planning areas, the first thing I like you to remember is that they're just regular folks. These are people often have families, love their families, are charitably inclined. So I always like to remember the first place I start with any business owner is what's going on with them personally, what's happening in their personal world. Often leads to an income replacement or human life value presentation and sale, and often that is paid for by business dollars with some of the concepts that we're going to take a quick look at this morning together. So with that caveat in mind, remembering that business owners are people first, and they often love their families and have charities that they're very attached to, keeping all of that in mind, let's start looking at that those opportunities that are out there in addition to that. And we've got a lot of pictures on this screen. You see the middle one, business succession, and up here on the left, qualified and non-qualified plans in Section 79 and estate planning and captives and premium finance. And we're going to touch on a couple of these today. And really because of our time limits, we're going to mostly look at how to approach the clients about these things, what some of the concepts are, and where you might want to start in having these conversations, and also some of the technical pieces behind each concept. So where I like to start is on business succession. As you can see in the picture, carry on, sell, transfer, there are lots of different possible solutions or opportunities when you think about business succession as an umbrella term. Let me just move the slideshow a little bit here. Hopefully it will move like it's supposed to. There we go. And I kind of call buy-sell measuring the opportunities. It's what are the possibilities. Now, business succession is a broader term than the term buy-sell. Now, business succession really does involve the question, all right, how are you going to transfer this business asset? And I will tell you that every business owner that you meet will have a business succession event happen to them in their lifetime. And you can see this little bit of a timeline here. You know the old phrase, there are two certainties in life, death and taxes? Well, I would tell you for those clients that are business owners, there are three certainties, death, taxes, and a business succession event. It's going to happen. Something will happen. A death will happen to an owner, disability, retirement, just termination, call it a day, liquidation of the business. These are all actual events. Some people just walk away and close the business. How the value of that business transfers to the business owner or to the business owner's families, how the surviving owners or the remaining owners continue on their business, how smooth that transition goes, often will depend on the kind of advice we bring to the table, the financial issues. Where will you find money resources to do these transitions? What kind of life insurance would you want to have to help you transition these both at death and during life. So those are the things that we can bring to the table for something that's an absolute certainty, at least the way I look at it. Okay, so how that transition happens is going to depend on a whole bunch of decisions the client makes now. Business planning, buy-sell planning is not just done by one or two people. You're often also going to be working with the client's attorneys, often with their accountants. Don't let that worry you. It's a very accessible thing. And I'm just going to step out of this presentation for a second, and I just want to demonstrate to you one tool that happens to be one of my favorite tools in looking at these things. And I'm just going to make this a little bit bigger so you all can see it without hopefully making you seasick. And it's something that we call the business succession stress test. What that is a nice, simple way to be able to share some ideas with your clients about buy-sell plans with a very unthreatening kind of way. It's set up as a series of yes-no questions. This piece happens to be a fillable PDF, so you can actually have a client fill it in and email it back to you, or you can use it live with your client, which is how I often use it. And if you think about push polls, you know, we're coming up to election season. I bet you every once in a while you'll pick up the phone, probably in the early evening, and there's going to be this voice at the other end saying, my name is whatever. Can I ask you just 4 questions about the upcoming election? And they pose the questions to you. Those are often called, they are push polls. And the reality is that they're not really interested in your answers. They'll record them, they might report them, but it's not the answers that they're concerned with. It's that by virtue of the questions, they're presenting an idea to you. So they're pushing out information through the form of a poll, push poll. And that's what this is, essentially. We're talking about a stress test, the way of asking a series of questions, but really designed to provide information to the client and actually to cause a little stress, to get them a little concerned about what they do have and what they don't have. So if you just, I'm just going to show you a little bit of how or what the questions are in here and show you how painless they are to ask and how I love the answers when they're don't know or no, because it gives you an opportunity to talk about more things. But here it's just the structure of the buy-sell arrangement. Do you have an agreement in writing? Well, yes, no, I don't know. And you'd be surprised how many people say don't know. Does your agreement require the business to buy your business interest? So what it's asking is this an entity purchase? In this form, we try to use regular English and not code words and not legalese. So rather than is it an entity purchase, is the business going to buy your interest? Or will your co-owners buy your interest, as in down here? Or is it a wait and see? Is there a key person buyout? Is there a third-party buyout? So you see, in the first 5 or 6 questions, we're getting the opportunity to find out, well, does the client have a buy-sell? Is it in writing? If they don't have it in writing, it's not really a buy-sell. Handshakes don't really count. Then you can get a little bit more detail, and a lot of clients just don't know the details. Well, they'll say, well, we think it's a cross purchase, but I'm not really sure. And so this gives you a great opportunity to offer to take a look at what the buy-sell agreement is, talk to their attorney if necessary, and get more information. What triggers the buy-sell? So if they do have the buy-sell, well, what's the trigger? Well, death. So if you've got a buy-sell that's triggered at the death, that's a perfect opportunity for providing life insurance as the funding mechanism. Disability, retirement, resignation, and in modern drafting, you'll also see triggers often as the bankruptcy of one of the owners or the divorce. So it's all laid out, and then on the back side of the page is valuation and funding. And if you'd like, we will provide this to you and get it over to all the right folks and be happy to share this with you. But what this does is now let you talk about valuation. Do you think it's a fair amount? And how are you paying for it? So when you get down to funding, even if you're doing this without using this form, are you depending on savings? Are you going to borrow from a third party? Are you going to borrow from the family? Or are you depending on life insurance or disability buyout or some combination, which is kind of typical? So I love to set the client or set the stage with the client with this kind of set of this set of questions. Again, it doesn't have to be in this particular form, but what it does do is really let you show the client that you understand what some of the issues are, that you are able to help them figure out what they already have, and whether what they have today is doing, or what the agreement calls for is doing what they want it to do, which is one of the big issues in buy-sell planning. You often get somebody who says, yeah, I've got it in writing, it's a cross-purchase, but we set the value 5 years ago and the business is worth 10 times that. What do I do? It's a great moment for any planner to be able to have that kind of situation. So if we think about it, there are really 4 types of buy-sell agreements. We have entity purchase. That's that one that where the question was, is the business going to do the buyout? And that's what you've got here. You've got the cross-purchase where co-owners are going to do the buyout. You've got a hybrid, which you'll see right down over here, which is where you've got a series of options. And if you like to Google things, go Google wait and see buy-sell, and you'll see a lot of definitions about that. That's just a series of options. So the business has the first option, and if the business doesn't do the buyout, the co-owners will. And then if there isn't a co-owner, you might have a key person or third-party sale. So on one page, if I've got a client who I've just had to ask a series of questions, and maybe they're saying, I don't know what I've got, or I think I've got this, I can very quickly direct their attention to how buy-sells work, and it's not hard for us to figure out what you've got. If you've got it in writing, we can take a look, and these are the likely choices that you'd have. So you see, it's not that hard to have the conversations. So part of what I have found when I've been involved in, I can't tell you how many hundreds of buy-sell cases, whether directly with the client or working with the planner. I have sat in lots of situations where the planner has presented a brilliant conversation about how buy-sells work. You know, is it a cross-purchase? Is it an entity purchase? Is it a wait and see? And they've gone through all of it, how it works. And in all honesty, I don't think I've ever seen in any of those cases that the case has actually been sold because the planner had a brilliant conversation around how the buy-sell works. It's an important conversation. It's necessary to move the case forward. The reality is that the client's attorney is going to make the call with the client, and maybe you by their side, as to whether it's an entity purchase or a wait and see or whatever. The real sale happens when you're talking about the funding, which is true of what we do, right? It's being able to show the client you can pay for this at a discount using life insurance, and that the economics of the life insurance are much less expensive than paying for it dollar for dollar. So you can walk the client through the 2 or 3 different ways to fund the buy-sell, and savings. Talk about with the client, well, you could save the money. And if it was a $500,000 or $1 million or $200,000, whatever that number is, you're going to have to save every dollar. You'll probably have to pay tax on that, or tax on the growth on that savings account. And the reality is, how many business owners really are in a position to save money? For the most part, most business owners take the money out and spend it on something personal by the end of the year. So it's a dollar for dollar, dollar plus tax. It's influenced by the number of years to the trigger point. So you don't know when the buy-sell is going to happen. You don't know if it's going to happen in year 1 or year 10 or year 20. How much do you save in any one year? It's influenced by your after-tax earnings rates and by the discipline of the business owner. Again, while there may be good intentions to do it, I've just never seen it done. Installment or borrowing, I kind of put those in the same bucket. An installment buyout or going to a third party, let's think about third party first. The actual cost for what you pay is obviously going to depend on the interest rate that you can get. If you're going to a third party, you're going to a bank, the first thing that you're going to confront is, can you get the loan? Is it really possible to get the loan when a key person owner has just passed away? It's more likely that the bank may call your loans than wanting to or happy to give you another loan. And if they're happy to give you another loan, at what interest rate? Again, if something significant has just happened to the client's business, they're not likely to get the best rate that the bank's got. How long will they want you to repay? Is it 3 years? Is it 5 years? 10 years? You know, the shorter the payback period, the more money that has to come off of the company's balance sheet, the more money it has to earn, excuse me, to do that, it can become a very expensive alternative. And then if it's an actual installment sale, the family that's waiting to get the money, they're actually making a loan to the surviving owners. They're saying, all right, you owe us this money over a period of time. What happens if the business can't pay it out? You know, most business owners recognize that they're going to have to pay other bills first, and it's the installment loan that's going to come second. You can leave a surviving family without the money that they thought they were going to get from the buyout, particularly where installments are either very short in time and the business owner can't make the payment, or very long in time, and over time the business may have trouble doing it. Which brings you to life insurance. The economics of the life insurance, obviously, it's you're going to be paying premiums usually to the trigger event, to the time that the person passes away or retires, and you use the cash value as down payment. And obviously it's influenced by age and health at the time you apply for it. But the reality is, when you crunch the numbers, the actual outlay and how much your client's business needs to bring in gross income to pay for all of the alternatives, I have rarely seen insurance not perform better than savings or installment and borrowing. Even if you take the number of premiums, add it up by all of the owners that you have to insure, and by the number of years you hope that the clients will survive, usually will take it to retirement and then use dividends to offset or interest to offset. The key is that the insurance will cost much less than installment, borrowing, or ultimately savings. And that's something that is important for us to be able to demonstrate to the client. So that's the buy-sell opportunity. Every owner, every business owner you talk to, whether it's the folks with the storefront retail business in downtown wherever you live, big manufacturing, little manufacturers, doctors, dentists, vets, on and on. All of these folks are business owners. Everybody you meet who owns a business, you need to have the conversation about buy-sell. It is one of those just great underserved markets. Many business owners don't have buy-sells, and those who do are often underfunded or unfunded. So it really is a great opportunity. Okay, so that's my conversation about business succession. Hopefully you can tell that I have a certain passion for this conversation. There are some clients who will be impossible and might say, you know, I trust my partner, they'll take care of the family, and you try to bring them through some disturbing scenarios. But most clients are interested in making sure that this asset that sits on their balance sheet gets converted to cash when they retire or pass away or become disabled. Okay, so that's business succession. Other opportunities in working for business owners, executive benefits. That's non-qualified benefits. And again, let's look at measuring those opportunities. When you're talking with a business owner, and usually when you start talking about executive benefits, this has been a business that's been around for a little while, not necessarily a new company, has a good profit margin, isn't just eating what they kill, but there's extra money. There may be a key person who is not one of the owners, and certainly the owners who are key people. What they may be looking for is opportunities to use their business money to provide personal benefits. For the business owners, it's seeing if they can do it efficiently or more efficiently than just taking the money out on an after-tax basis, which is how a lot of plans go, and that's perfectly all right. And when it's for provided to key people who aren't owners, what the business owner is really looking at is, all right, do we have some short-term incentives that we can put in place, long-term incentives that we can put in place? These two are really designed to make sure that the key executive is happy in the short term, happy in the long term, and that the incentives are really designed to reward good and continued good work. For the business owner, some of the decisions they'll be looking at is current taxation. Is this something that we're going to get a tax deduction today? And sometimes for some business owners, tax deductions really motivate everything they do. For some business owners, they recognize that tax deductions may be good, but if you can have more efficient withdrawals at the other end of the plan, that might be better. And as you design and work with clients, you'll get to see what those situations are. Again, you get some clients who say, listen, I need a tax deduction now. And so you'll be looking at executive benefits that create current tax deductions for the business. And there are some business owners who say, I'm more than happy to create an incentive plan for my key people and even for myself. But for my business's longevity, I need to make sure that there's some cost recovery built in. The great news about non-qualified plans is that depending on what's key to the owner, to the person that you're working with, that there's probably a plan that you can design around those key issues. Now, sometimes we create plans that combine a couple of different arrangements because the client is saying, well, I need a variety of different things to hit, and maybe not one plan does it. But just think that the great news about non-qualified benefits is that there are, again, also some things that are very simple and some things that are fairly complicated and some things that kind of fall in the middle. So for clients who have, let's say, no head for complexity, it's got to be simple, it's got to be straightforward. Well, on that side of the spectrum, you've got bonus plans. On the other side, which is bonus plans would sit here, on the other side, you may have somebody says, I understand all the nuances, this is a business that's going to continue. Well, you might end up with something like a deferred compensation plan. So let's take a quick look at 4 of the key benefits that we see talked about today and actually being put in place. And on the less complex side of the equation, and probably the most popular of the non-qualified plans, is executive bonus. And some of you might be familiar with this as 162 bonus plans. Again, if you like to Google, you can Google Section 162 bonus or non-qualified executive bonus. By the way, that 162 is simply the tax code that tells us when we can deduct these kind of plans. And it works very simply. The business is going to bonus the premium on a permanent life policy owned by the executive. The reason we use permanent life is because of all the benefits that are built into the permanent life policy. Hopefully you're using a policy that has good accelerated benefit riders, good guarantee income riders, cash value that grows on a tax-deferred basis, the opportunity to take money out of the policy on an income tax-free basis. So up in here for the business, it's fully tax deductible. So you get 100% tax deduction. So if I write a check for $1,000, that's a $1,000 deduction. That bonus, that premium paid by the business, will be included in the executive's gross income. So for the executive, the out-of-pocket cost to acquire this permanent policy is the tax due on the bonus. So if it's a $1,000 bonus and my executive's in a 25% bracket, the executive's cost to get this policy is $250, which can be a remarkably good deal for the executive. And again, this executive could be a non-owner, could also be an owner of the business. So again, executive's cost, tax on the bonus, acquires this permanent life policy, is the owner, will name their own personal beneficiary, and everything works out, again, because it's a personally owned policy. The executive has control over the cash value, accelerated benefits, et cetera, et cetera. Again, very popular. There are variations on the theme. One popular one is where you put some restrictions on the use of the cash value for a number of years. So that you've got some golden handcuffs on the executive. They can't just walk away in year 3 and take this partially funded permanent policy. And you can use all kinds of permanent products. You can use whole life. You can use IUL, et cetera, et cetera. Okay, so that's executive bonus. Now, on the other end of the scale, this scale being nice and simple, you don't have to send notices to the IRS or the Department of Labor. It doesn't even have to be in writing. The bonus can vary each and every year. You can give different bonuses to different people. Other end of the scale, selective incentive plans. Some people like to call them deferred comp. I only call deferred compensation when the client's actually deferring, like you see this line over here, where the executive actually defers income. So you don't have to have an actual deferral of income. It can be simply that the business is making a promise to pay. And that's all this is. Here you have the business, and it says to its executive, and in this case it needs to be either management or highly comped executive to participate in this plan. The business says, look, I promise to pay you something at some time in the future. Excuse me. And that something can, wow, it can be just about anything. It could be defined benefit where they say we're going to pay you $25,000 a year for 15 years, as an example, if you get to retirement. Or it could be a defined contribution. Well, we're going to put away $10,000 in an informal account, and we'll pay it out to you when you retire at some interest rate or some measure of growth. So again, a promise to pay some amount at some time in the future. The business will often purchase permanent life insurance, and the business will be the owner and beneficiary. So the policy functions as a key person and as a cost recovery tool. And so when the business has to pay the benefit out, they can reach into the cash value, and hopefully the cash value is grown enough to help pay part or all of the benefit. When the executive passes away, the business will use the death benefit to completely cost recover the whole cost of the plan, both what it costs to pay for the insurance and the amount of money paid out to the executive for retirement. This can also be a plan that provides death benefit to the executive's family, and of course the business would use the policy death benefits to pay for that. So what happens here is the business gets a deduction, but only way down the road when you pay out the benefit. So for the bonus, you get the deduction today. For the selective incentive plan, you get the deduction down the line when the business finally pays the benefit out to the executive. For the executive, it's a great deal because they don't have to pay tax on anything until they actually receive the benefit. So for the executive, that's a great tax-deferred way of creating a retirement benefit. When you're thinking about clients that you might want to talk with about this, a couple of things to look for. You need to be sure that that business is going to be around for the period of deferral. So I've had clients who say, I love the idea. I say, okay, what kind of business succession plan do you have? Because you're providing this to the executive. If you retire, what's going to happen to the business? And they tell me, well, the business is going to retire. I said, well, that doesn't quite make sense in a planning point of view, because if the business goes away, there may be nothing there to pay the executive out this benefit. It becomes a meaningless promise. So you want to make sure that you have a business who's got some business continuity plan in place, business succession plan in place, and excuse me, can actually make the contributions into the permanent life policy, because you also want to be able to provide the executive some comfort that the money is going to be there. So this is also just a little bit more complicated because the IRS has put a bunch of rules in place. Those rules include you need to have the agreement in writing, the promise, the deferral. Those things have to be made in certain timely fashions. You have to send a notice to the Department of Labor that you have the plan in place. And when you have a business as the owner of a life insurance policy on any employee in the business, by the way, this applies even to employees who are owners, you do have to notify the IRS, you do have to notify the employee that a policy is going to be purchased. And for those of you who like technical detail, you find that. You can write it down, section 101J, J as in Jack, of the tax code. And that just says that for this death benefit to be treated as income tax-free life insurance, you have to have a notice and consent. And that notice and consent simply says to the insured, we want to take out a life insurance policy on your life in the following amount, and we can keep that policy even after you leave the business. You get that done before the policy is issued, and you're in good shape. So again, a lot more detail in selective incentive plans and executive bonus. So in between those are two things called split dollar. And for those of you who remember split dollar from 10 years ago, I would ask you to forget everything you ever learned, everything you ever knew. The rules changed in 2001 and 2002. Then finally in 2003 we got a set of final regulations. The split dollar economic benefit is a great death benefit only plan. So let's say you have a client who wants to provide some benefit to their executive teams or to their key people, and but they want to make sure that the business has key person insurance in place to make sure that the business is protected against loss of that executive because of death. Well, in the split dollar plan, you can put those two concepts together. All that's going to happen is the business is going to buy a policy, be the owner and partial beneficiary. That's the split. So the business will be part Benny, and the executive's family will be part Benny. It's a lovely, simple plan. Simple not being in the terms of qualified, an easy plan to put in place. You do need to have it in writing, so you would have to have an attorney draft it, but it's just elegant in that it gets the executive a certain amount of death benefit. The cost to the executive is the term value of the death benefit measured by the term insurance rates that the IRS gives us or that the insurance company can provide. So the executive's out-of-pocket cost is the tax on the term value of the death benefit. So it's a very inexpensive way for the executive to have some income tax-free death benefit available, and a great way for the business to kind of kill two birds with one stone, have a key person policy and still provide a benefit. The flip side, a little bit more complicated, is a split dollar loan, where the business says to the executive, whether it's the owner or a key person, we're going to help you acquire this permanent life policy, and we're going to do that by loaning you the premium, part or all of it. You'll either pay interest back, or maybe we'll forgive some of the interest depending on the deal. But in a conservative plan, the executive's out-of-pocket cost will be the interest that's due on the loan, and the business will cost recover. It will get the loan amount back. So again, a nice, interesting way for the executive to get permanent life policy at a relatively low out-of-pocket cost. Okay, so that's executive benefits, non-qualified executive benefits at 35,000 feet. And the key is when you're talking with your business owner clients is to first find out, are they providing themselves any benefits, or would they want to see if there are more efficient ways to get benefits for themselves? And are there any key people that they want to provide benefits to lock them into the business to make sure that that key person is kind of a happy camper and ready to go? The good news as far as the kinds of business owners, if you've got somebody who owns a limited liability company or a partnership or an S corporation, all of these plans work for when you're providing benefits for key employees. If you happen to have a C corporation, this will work for both the owner executives and for the key people. So great opportunity in the non-qualified benefit world. When you're talking with your clients about it, remember for some clients it's a greed conversation. We want to see if we can get ourselves more benefits and not have to provide benefits to everybody. At National Life Group and a couple of other companies, and in the executive benefit marketplace, there is an interesting concept that we have given the very attractive name of Section 79, and sometimes we call it Section 79 permanent plans. And this takes advantage of language that's actually in the tax code. And it happens to be Section 79 in the tax code. And for those of you who are familiar with Section 79, you'll know that I'm talking about group life insurance. Now notice I didn't say group term, because while some parts of the Section 79 refer to group term, when you get into the regulations, it makes it very clear that group plans can be funded not only with term insurance, but also with permanent insurance. And when you have a specially designed product that works within the rules set out by the tax code, you get a very interesting solution. And the solution is this. Would you like to have a plan, a group term plan or a group plan, where you provide base benefits to everybody, give everybody an opportunity for other benefits, but ultimately provide yourself permanent benefits at about a 30, 35, or maybe even 40% discount than if you had done just a bonus plan? Think about that for a second. You're saying to the owner employee, and maybe a key employee or two, would you like to acquire your permanent life at a 30, 35, or 40% discount? Kind of depends on certain factors. Well, how is that possible? Well, under Section 79, what they tell us is you can create a plan. The company is going to contribute into that group plan today. The company will get a current tax deduction, so for the business, 100% tax deductible, and the results for the participants on the permanent portion, for those people who opt into the permanent life, about 35 to 40% of the premiums excluded. And on the group term, remember, you'll pay Table 1 on any amounts in excess of $50,000. Let's try to make that a little clearer. Okay. First, let's think about the client. Is it a good idea for your client? Well, first, let's think about the business owner. If the business owner, let's say, has already maxed out on qualified plans, put everything they could in, whether it's a profit-sharing plan, defined benefit, 401k, whatever it is, or they don't have a qualified plan at all, and they're trying to or starting to really think about, how can I put money away in a tax-efficient method, in a tax-efficient asset, and perhaps have the potential for tax-free income at the back end? Is there any kind of plan that will do that? Well, Section 79 is an opportunity to do that at a discount. Also, for key people, you can provide a very attractive benefit through that. And taxes, well, if you have a tax-motivated client, somebody says, I am only doing a plan if I can get a full tax deduction and some tax advantages personally, that's the client that you're going to start thinking about Section 79 for. Okay, let's think about how it works. It's a classic concept, right? Section 79, group life insurance. You're going to provide the benefit to or offer the benefit to everybody. So it's tax advantage. What the code tells us is that the business is going to get 100% tax deduction, already mentioned that, and a special tax inclusion rule. Already mentioned that this is a 30 to 40% discount. Some people like to think about express it as what's included in income. So in some plans, let's say the premium is $10,000. 100% deductible by the business. In a traditional bonus plan, that full $10,000 would be includable in income. Under a Section 79 plan, only about $6,000, somewhere between $6,000 to $7,000 would be includable in income. So there's the discount. And what are you getting? Well, the individual who takes the permanent policy, they're going to have life insurance, death benefits, and cash value and living benefits, all the ABRs and the Liber Riders and all the rest of that comes along. And for other employees who don't opt into the permanent benefit, they're going to get an income tax-free death benefit. Okay. Whoop, let me go back one. Sorry about that. So I just want to mention here what you need to offer in a Section 79 plan, so you can keep that focus. Section 79 plans are 3 options are offered to the employees. Option 1, through a group term policy, $50,000 of death benefit, 100% deductible to the business. Nothing is includable in the employee's income. Great deal. Most rank and file take that. Option 2, also fully deductible to the business and provided through a group term policy, is a multiple of income. So if you have to earn $100,000, let's say, and the multiple is 10 times income, your death benefit would be $1 million. And you can, as many variations on the theme as you can think of, is what you can have as a multiple. So option 2, multiple of death benefit. What's includable in income, first 50,000 is excluded. Then what you include is the table 1 value of the death benefit. It's essentially the special term rates that the IRS has put together and you find in the tax code. So economical way for the employee to acquire death benefit. And then option 3 is a permanent policy. It's the same as option 2, same death benefit, but you're going to get it now through a permanent life policy. And if in that case the policy premium, let's say again, is $10,000 to get that $1 million death benefit, $10,000 is deducted by the business, but only $6,000 or $6,500 will be includable in income, and you get to have the permanent policy at a cost of the tax on what's included. So it's just a remarkable benefit. We find it very effective, again, for clients who are very tax motivated, who love the idea of a tax deduction and only partially includable. They love the idea about being able to take the money out of the policy anywhere along the way, really, but at retirement, and hopefully be able to take it out on an income tax-free basis, death benefit delivered on an income tax-free basis. The clients also that you're going to look out for, and including those that are tax motivated, these are 5-year funding plans. So you kind of want to make sure the client isn't just, looking at a very good year and can afford the deal in year 1, but may not be able to do it in year 2. That's not the right plan for those clients. So clients who have shown the ability to accumulate this kind of money are really excited about getting tax deductions and a tax-favored discount on the amount that the employee is including in income. So a great plan for those. So we've looked at Section 79, which is in part a non-qualified plan. We've looked at some non-qualified plans, and we have looked at business succession, and I hope you're seeing a theme here. The opportunities for business owners, if you start with business succession, start with their personal planning. Think about that with them. Don't forget that. Business succession is that first thing to talk about. What's your situation? And then kind of segue into the opportunities for retirement planning and helping clients acquire permanent life, the death benefit, and the cash value growth. Non-qualified plans in Section 79 are great solutions for those situations. Last but not least, qualified plans. Clients, let me go to the next slide. If you think about that timeline again that we've looked at a number of times now, qualified plans are where you can, the employer will contribute today. So they've got the cash flow now, and they get that current tax deduction. So again, you've got tax-motivated clients. People are saying, I need a tax deduction. We're leaving or giving so much to the government today. And those clients also may believe that when they retire, they may either be in the same tax bracket or maybe in a slightly lower tax bracket. Because what will happen is the assets inside the qualified plan are going to grow on a tax-deferred basis. But when you finally pay it out, whatever the employee or the participant receives will be includable in gross income. So current tax deduction to the employee, nothing included in the participant's gross income at this contribution. It grows tax deferred. At the time that the plan pays the benefits, that's when the participant's going to include it in income. Well, the great part about qualified plans is tax advantaged. You get tax deduction, not includable, and tax deferred. You get to reward yourself, because believe it or not, while there's always a lot of conversation about how qualified plans have to be set up for all employees, there are many designs that can favor, quite legitimately, highly compensated and the highly compensated owners of the business. I have seen defined benefit plan, and again, it has to be the right ages and the right number of employees. I've seen defined benefit plans designed so that well over 95% of the benefits are going to the owner employees. There are some plans that won't work. If you've got a lot of employees, you're probably looking at plans like profit-sharing plans and 401ks. If you have a small number of employees, less than 10, employers are the older employees, traditional defined benefit or fully insured, some folks like to call it by the tax section, 412E3, used to be 412I. Those might be the right kind of plans. Now, I know I'm throwing a lot of information at you with all that, and what I want you to do is recognize that for clients who are looking for tax advantages, who are looking to reward the highly comped, you can still use qualified plans to do that. Remember, you could be looking at profit-sharing plans, often tied with, but not necessarily 401k plans. Where you have clients that have relatively few employees, let's say 15 or less, and the employers are older than most of their employees, or the key people, the highly compensated, the people you want to really get most of the benefits to, are older than the rest of the employees, spend a little time thinking about defined benefit plans. You can get much higher contributions into a DB than you can into either a profit-sharing plan or a 401k. We've seen a remarkable amount of money being able to go in here. And if you've got the right set of facts, a fully insured or a 412E3 plan, you can really see even higher contributions going in there. And the key in here is to make sure you're working with a really sharp design team. Okay, and defined benefit plan, contributions based on the plan benefit. That benefit's going to be paid out to the participant at retirement. Again, all remember, tax deductible to the business on the money going in, tax deferred growth, and then taxable when the money comes out to the participant. Okay, so there are all kinds of plan designs possible. Excuse me, losing my voice in there. Just a couple of other notes. And then if anybody wants to ask questions, I'm happy to take any questions. I know we've covered a lot of ground here. Estate planning for business owners, a lot of times the place that you're going to find wealth for clients that might actually generate any kind of a federal estate tax or a state level estate tax, those are often our business owner clients. Often business owner clients will also have qualified plans because a lot of wealth you'll find in the qualified plans. When you're talking with a client about that and they're saying, well, we've got a business, it's worth $8, $9, $10 million or more. I've got a qualified plan balance that has lots and lots of money in it. You need to start thinking a little bit about the estate planning side of working with business owners. We have seen clients or potential clients who really could look at a big tax bill. And just as a reminder, right now, for federal estate tax purposes, for a single individual, the threshold number is $5,340,000. That's the credit amount. That's the exemption amount. So if your client has a business that's worth over $5 million, qualified plan that's got $2 or $3 million in it, maybe a Section 79 that's got $1 million or $2 million in it, and I wish you all these kind of clients, but it does add up, and it can easily drive the client into an estate planning or estate tax bracket. So we need to think about how businesses can be transitioned, maybe how to place some of that insurance in irrevocable trusts to protect some of that money. But I just wanted to, keep that light bulb in your head as you're adding up business value, qualified and non-qualified plan values. Just keep that threshold amount in mind. So the $5,340,000 for an individual, you can add it up, $10,680,000 for husbands and wife. As an aside, the IRS has told us that they will recognize same-sex marriages for these purposes as long as that marriage occurred in a state that recognizes same-sex. So they call it the state of celebration. So estate planning often comes as part and parcel in working with business owners because, again, much of the transferred wealth in the United States does come from business owners. And I think we make a mistake calling it small business owners. That's why you don't see that term in my presentations. Often these aren't small businesses at all. They are closely held. They're not public. So I am happy to take questions if that's possible. I don't know if you wanted to do that.
Excellent,
Jamie?
Ellen, and nope, Ellen, that's great, and we do have quite a few really good questions here, so I'm going to go through just a few of those. We'll try to answer. Also, want to point out to everybody listening today some of these excellent handouts that Ellen is talking about, including the business succession stress test. We do have those here. So as we go into the next part here, I'm going to put Ellen. I'm going to go ahead and put the presentation up here with our phone number on it. That way, as people have any questions, anything that you're looking at is outside of this, definitely give us a call. We'll work through that. Now, there's a ton of great questions, and the first thing I really want to point out is our relationship with the National Life Group. Extremely strong. For some of you, there's actually a story in here about losing a sale with an accountant and a CPA and an attorney that was kind of wrecking the deal for you. Also, there's questions in here about marketing materials that National Life Group has, and list of questions for when you're cold calling. That is one thing your appointment with the National Life Group will really help you with. Also, your relationship here with Premier. So after the call, give us a call. We'll go through this with you. We've got that excellent handout. Also, Big Mike Zimmeretti, the Vice President, just sent over business and estate planning opportunities. A guide just came out from National Life Group. Again, all these tools will help you build your competency. That way, when you walk in there, you can take this excellent training that you got from Ellen and actually apply it to your clients. Ellen, just kind of going through some of these. One of the first ones that they ask, does the executive bonus plan? They're asking if that fits with all different kinds of business entities, and if not, which ones would that exclude?
It does fit with all business entities. Particularly when you're talking about providing the benefit to a non-owner. So for non-owner situations, all business entities work great. Where you have the owner as the party benefiting, C corporations works perfectly. When you have a pass-through, it's 6 of one, half a dozen of the other as to what you call it when you're providing the benefit for the owner. You can call it, we call it bonus plans, but because it is a pass-through, whether you call it a bonus plan or not, it's going to be tax deductible at one level, but it will be includable to the owner at the other. So it by its own nature is a bonus plan, if that makes sense.
Absolutely, absolutely.
Okay.
Another question here, Doug asks, what about farmers or ranchers? What do you think would be the best or most seen application in that scenario?
Depending on how organized the farmer or the rancher is. Now, some farmers that we've worked with have been remarkably organized as business owners, have created a variety of business entities. Some handle one part of the business, some handle, other business entity handles others, in which case any of the programs that we're talking about make a whole lot of sense. Then unfortunately what we do often find, especially in the family farms and the family ranchers, and they've just been passing the business down to the next generation, the planning is still business succession, but it brings in really required to do a lot of also estate planning, not estate tax planning necessarily, but estate planning, looking at ways to make sure that the farm or the ranch gets down to the family that will work it, and then the rest of the family kind of gets, let's call it a fair treatment, and I always put that word in quotes, because fair is different family to family. How much will those kids get? And those benefits are most often provided through life insurance.
Great answer. We appreciate that, Ellen. There's another one in here. This question, I think they just want clarification about who structures the incentive plan. Would that be the lawyer, the client's lawyer, the insurance company, or the company themselves? Who usually is the one that kind of decides that?
It's often a combination. It's rarely the insurance company. It's for practical matters, it'll be the business owner, the planner, and a lot of times the accountant. Many times the attorney will come in, and attorneys do a lot of drafting and will advise on the details of it and make sure those pieces are right. But the economics, that's going to be the planner and the accountant.
Excellent. Jorge asked the question, can the owner of a non-corporation get an executive bonus plan?
Of a non-corporation. So if
So
we're
I'm assuming
talking,
he's talking about like a sole proprietor, like a life insurance agent maybe?
it's going to be after-tax dollars.
Okay.
You won't have an opportunity for a tax deduction in a sole proprietorship, so it is after-tax money.
Excellent. What attorney discipline is good to partner with on this? Deanne asked that question.
Okay, so you want, let me do it by a series of eliminations. The attorneys that you want to work with who understand executive benefits, so the split dollar and deferred comp and that is a real specialty. So if you're working with somebody who's got a good practice but they do mostly real estate or wills and trusts and that kind of thing, you're going to need to look elsewhere. Because it is a true specialty, a true discipline. For buy-sells, for the most part, a general practitioner will work with that well enough, and you don't really find people who just specialize in buy-sell plans. It would be hard to find that. So a good general practitioner who understands how to find good drafts, and by the way, always happy to provide sample documents. So we will certainly do offer that to anybody who's working with Big Mike. So the executive benefits is going to be a real specialist. Buy-sells, most general practitioners will work fine with that.
Excellent, excellent. Now there's some other questions in here. I want to point this out. There's some things about further training. There's one joke in here about the week-long seminar to learn all this stuff. The
Sure.
one great tool, one great tool we get, everybody, I really like to stress this, National Life Group is, they're different. They separate themselves from the rest of the competition of their carriers by having a full arsenal of tools that normally would only be held for captive type people because they come from that background. That's available to you at any time, including video, audio, reading materials. You could literally have anything you want at the access right at your fingertips. Plus, they have people like Ellen that can help you with this. So feel free to give us a call. In fact, we've been talking with Big Mike. He's very interested if you're that person out there looking to transition into more of these kind of sales and you're serious about it. We'd definitely like to sit you to the side and get you some individual training. That way you're razor sharp at this. So perfect. Moving on to the next topic here. With a couple things I'd really like to point out as far as Premier, looking past everything else in the industry, we do offer full underwriting support here in-house. So if you have that case, just not sure what to do with it, whether it be a large business owner all the way to just somebody looking for term insurance with health issues, give us a call. We're here to give you that support. We can also pull in professionals like Ellen if you need her, and even if it's something that she doesn't particularly handle, she'll help us get to that right person in the National Life Group. So great resources. We do offer cutting-edge technology, including quote engines, e-apps, online contracting. We also have a system called X-Ray and much, much more. So if you're interested in any of this, give us a call. Last but certainly not least, experienced marketing staff. Here at Premier, that's the one thing we offer is that we can help be the liaison between you and your client to get you set up with anything you need, including marketing materials. Somebody had asked about that on the questions. Also fresh sales concepts, just helping figure out which person to talk to next. So with all of that, Ellen, we appreciate you taking some time to join us today. You've been very helpful and very educational, and we hope to do a lot more business with you.
Sounds good. Thank you. Everybody
Excellent.
have a great
Anybody
afternoon.
have a question? Excellent. We appreciate it. And anybody has any questions, our phone number again at the bottom, 800-365-8208, and you all have a great day. Thank you.
Okay.